Thanks so much for joining us on a brand new episode of the Banking Bros podcast. In this episode, we've got a special guest. It's Anthony Rushing, and he is coming to us from his company, his organization called First Lien HELOC. Not only in this episode will he walk you through if a first lien HELOC is right for you, if it makes sense, if it works, but he'll also walk you through what it is so you can understand if this is a financial strategy that you want to employ in order to get out of debt a little faster, pay off your house a little sooner, pay less interest to the banks and third parties. There's a financial strategy that's accompanied a lot of times with the first lien HELOC, which is called velocity banking. And velocity banking and the infinite banking concept that you hear about on our channel are things that work in hand tandem. They're perfect for each other. And so if you've ever considered that, if you've been wondering what velocity banking is, if you've never heard of a first lien HELOC, but if paying off your house a little faster, paying less interest, paying off debt a little quicker has interest to you, then you have got to stay tuned and hear what Anthony has to say. We look forward to jumping into that conversation with him on this episode of the Banking Bros podcast.
In this edition of Nelson's Notes, we talk about what he means by the infinite banking concept. And right here at the beginning, on page 3, he says it like this. This book is not about investments of any kind. The infinite banking concept is about how one finances the things of life, which can certainly include investments. It's not about rates of return. Thanks for that reminder, Nelson. Back to studio.
Anthony, thanks so much for being here.
Absolutely. Thank you, Jonah. I'm really excited to chat with you today and share a couple things. Hopefully it's valuable.
Yeah, of course. Okay, so you've got to give us a little bit of a rundown for those out there who are listening or watching for the very first time, and they're just a little confused on first lien HELOCs in general. Give us a little bit of a rundown. Give us kind of the 101, if you will, for all those newbies out there.
Absolutely. So a first lien HELOC is a mortgage product. It's available. It's been available for a long time. It just functions differently than an amortized mortgage, and it's different than a second lien HELOC. So in order to kind of understand what it is, what I like to do is first hit on how it's different than a second position HELOC. So second lien HELOC opens a line of credit on top of your existing mortgage. This is still a line of credit. However, it actually comes in and replaces your mortgage. So it pays off your mortgage to create one big line of credit, and the balance it initially has on the front end is the mortgage balance that you had before. That's how it's different than a second lien HELOC. When we're talking about the lien position, basically if you're in the first lien position, that just means that that's the entity that gets paid first if someone defaults. So that's basically what we mean by a first lien HELOC. So then the question is, how is it different than an amortized mortgage? Because both of these are in the first lien position. An amortized mortgage, when you refinance, comes and pays off your existing mortgage. A first lien HELOC comes and pays off your existing mortgage. So there are two main ways that a first lien HELOC is different than an amortized mortgage. One has to do with money flow, and the other one has to do with how it calculates interest. Money flow wise, your amortized mortgage is called a closed-ended loan. So money can only flow in. You can pay it down as much as you want, but it's stuck once it's in there. And so you can't take it back out unless you do a cash out refinance or unless you sell the home. A first lien HELOC, money can flow in and out freely. So what that means is anything you put into the HELOC that is used to pay down the balance, you can take back out if you want. Obviously, you take it out, it increases the balance again, but it's open-ended. It's called an open-ended loan. So what that means is you can safely put as much, you can put as little, you can put everything into this if you want safely because you're able to take it back out. The second difference has to do with interest calculation. So the way that your amortized mortgage calculates the interest each month is it uses the previous month's end balance. And it uses that end balance against the rate to calculate your payment. And that's just how they're done. The right first lien HELOC, and the bank was very specific that I'm supposed to say the right first lien HELOC because I can't know if all first lien HELOCs calculate interest this way. But the right first lien HELOC, when we're thinking about the strategy that people use, will calculate interest using the average daily principal balance. So it doesn't look at the balance one day of the month. It looks at all the balances throughout the month. It takes an average of all those balances. And it uses that average balance against your rate to calculate the payment. So basically, it's a first position mortgage that just works differently. It's open-ended. And it calculates interest using the average daily principal balance. So that's basically what it is. it's just a tool. It's a vehicle, and by itself, that's all it is. I think the thing that makes it special a lot of times is using it the right way to achieve certain goals.
Yeah, I love that. I can tell you the first time that I heard about a first lien HELOC, the two things that you brought up are the two things that stood out to me most. The first was, well, I would never put all of this extra money on my home, and a lot of people out there listening or that I've talked to feel the same way. I'd never put another $5 or $10 or $15,000 on my mortgage payment because then the money's gone and I can't use it and all of those things that we talk about and we teach on our channel. And that was one of the first things that stood out to me, like, oh, hold on a second. I have now the ability to put the money on the mortgage, so to speak, the first lien HELOC, because it has that flexibility to go in and out, that liquidity. What have you seen, Anthony, if you don't mind me asking, like, are people using first liens and paying off their house a lot faster? Are they going slower because of this, or is it more based on the strategy?
It's a really good question. So just so everyone's clear, this doesn't work for everybody. It's not a fix-all for every single person. I think that can be a misnomer, and I don't want it to be perceived like I'm saying that everyone should get this and it's going to work for everyone. That isn't the case. But what we do is we teach people how to take the structure of a first lien HELOC and maximize how it works for them. And so because it calculates interest daily, it makes sense to get the money in there as fast as possible. And you get as much money in there because that creates the lowest balance as fast as you can. The sort of mantra or the catchphrase that I always fall back on that will always be true is when it calculates interest this way, you just need to create the most number of days with the lowest balance. Most days with the lowest balance. So we teach people how to leverage that functionality to pay off their homes extremely quickly. So when it works, when people choose this, it's because the strategy that we teach allows for them to pay down their home extremely quickly, pay off their home. The hook is pay off your home in as little as 5 to 7 years. So right now we're tracking, our portfolio is tracking to about 7.1, 7.2 year payoff overall. So the customers that choose this do so when it allows for them to use it in a way to pay off their homes really quickly.
Yeah.
And by creating a shorter payoff time, even with a higher interest rate, they can save tons of money, even compared to lower interest rate mortgages. So yeah, people are using it to pay off their homes really quickly. It's not a one size fits all, but when it works, those are the kind of outcomes that we're seeing.
I love that. Man, 7 years sounds a whole lot better than 30 or 50 they were trying to talk to us about a few months back. Okay, you mentioned the second thing, so I want to ask, and again, I'm maybe playing a little bit of devil's advocate just for the people who are listening and watch. Okay, so if interest is calculated on the average lowest daily balance, or not lowest, sorry, averaged balance, daily balance within the month. There it is, right? If that's the way interest is calculated, how does that compare to the kind of conventional way that interest is calculated on your mortgage now? If you switch from a traditional mortgage to this first lien HELOC idea with the intention of paying off the house, are you going to see in a typical month a higher amount of money going to interest, a lower amount of money going to interest? Is it about the same? And of course, and then over the course of your loan, of course, if you're going to pay off your house in 7 years, then we are going to pay a lot less interest than we normally would with a traditional mortgage over 15 or 30 or something like that.
Yeah,
but what about month to month?
It's a good question. There are a couple of variables that are unknowns that we have to account for. If the rate on the first lien HELOC is substantially higher than the interest rate on your amortized mortgage, at the very beginning of getting the first lien HELOC, your balance is going to be pretty much the same as the balance on your mortgage. Well, even with the average daily principal balance and creating a lower average balance than what the mortgage would use, that's not going to overcome at that point in time the fact that there's a higher interest rate. Again, it just depends on how far off you are. So you can expect at the beginning, the first months, the first couple, maybe a couple years, but the first year to pay a little bit more in interest because the rate's higher and the balances are similar. The strategy isn't about creating a low interest payment this month.
Yep.
If someone wants a low payment right now and that's their focus and that's what they need, this isn't going to accomplish that. What this does is this helps you pay off the home overall, sort of a long-term play, right? So overall, the total interest that you pay is substantially lower because this whole strategy is about balance manipulation. And so basically, I don't know if we've actually gone into that yet, but the strategy allows for you to leverage everything that you have and dedicate that toward paying down the house. So you drive in all the income, and that takes everything that you have in real time and drives down the balance to the lowest balance that you can create. If you're doing it correctly, there's no money anywhere else. Everything is here to drive down the balance to create the lowest balance possible. And then you take away from that to pay your bills. You pull from that to cover your expenses for the month, which increases the balance. So at the end of the month, every single dollar of your surplus is simply still in the first lien HELOC. Everything. And so it allows you to leverage everything that you have to manipulate the balance, to drive down the balance. And when you're able to do that, it allows for you to arrive at a low balance in a short period of time. So the way I like to think about that is it's possible that high rate against low balance results in low cost. And so if we think about that, even if I don't pay it off completely, if I just pay it down to a very low balance, I can still enjoy the fact that I'm paying low interest cost, even with a high rate, because high rate against low balance. Or if I'm only paying interest for a short period of time, I like to use extremes when talking with people. I'll ask them, if you could pay off your home in 1 year, would you be scared of a 13% rate? And they're like, no. I'm like, well, why? And they say, well, because I'm only paying it off in a year. I was like, you're right, because the shorter period of time, it's easy for us to logically understand it with that extreme. Well, that's a concept that's true with 1, 3, 5, 7, 10 years. The shorter the payoff time, the lower the interest cost and less the rate matters.
Yeah.
So that's kind of what we're saying.
I love that. We teach people all the time. So if you are an avid listener, you have heard it before, but it's not about the rate. It's about the volume. And so when I hear you talking about the first lien HELOC, that phrase comes back to my mind. Oh, it's not the rate, it's the volume here. And if you've got an opportunity, like you mentioned, to pay off the home in 5, 6, or 7, or 7.1, like you mentioned earlier, yeah, it's where you're seeing things these days, then it's not rate here, it's volume, folks. It's volume. Right. Which I love. Okay, you mentioned something earlier we definitely have to talk about. You said this strategy, getting a first lien HELOC, using all of your income, all of your resources to go into the first lien HELOC first, which then lowers that balance pretty much as low as it's going to go for the month.
Yep.
Then drawing from the HELOC in order to pay your expenses and your bills and things like that, which will take your balance back up. But again, you'll have that low balance to start and coming back up through the month, which is how the interest is calculated to give you the lowest interest cost, and rinse and repeat that over and over until that home is paid for, which is amazing. But you said that this is not for everybody, and you were kind of clear about that. Hey, I don't want you to think it's for everybody. I'm not saying that. So talk to us. If they're at home listening or watching, how do they know it's for them? You know, what type of things should they be paying attention to? How will they know? What should they look for?
So there are a couple steps in terms of understanding whether this is going to be a good fit for someone. First is sort of a broad understanding of what it takes for people to succeed here. And so that's a place where you can sort of filter into that this might be a good idea or it's not, right? If we think about the strategy itself, the income is paying the principal down. And when you drive in the income, that's essentially your principal payment. And so if that's $8,000, you make an $8,000 principal payment with everything you have. But here's the catch. You take away from that principal payment when you pay for your expenses, when you pay for your bills, the interest on the HELOC too. So for a household that the income is close to or meets the expenses, what happens is in that $8,000 scenario, you make an $8,000 principal payment with everything we have, and then our lifestyle requires $8,000. So we take away from that principal payment to pay all of our bills. Well, if we take away everything we put in there, right, down by 8,000, up by 8,000, our balance stays in the exact same spot. It would not work for that scenario. Well, that's a household that is tight on their budget, right? That's a household that may be struggling to make the bills. Even if there's a little surplus, right, $100 or $200, probably not going to be enough to overcome that fact. When I first started this, for the first year and a half, people would call and they'd say, "Hey, Anthony, do you have a first lien HELOC?" And I'd have to tell them no. And then they'd go down the path of, "Well, you say this is the best thing since sliced bread, and you should have it. Why don't you have it?" And I would ask them, I was like, what does it take for someone to succeed here? And they said, "Well, you have to cash flow." And I said, "I have 3 kids in daycare right now."
Yep.
I was like, "I don't have any money. Like, I'm calling my parents to borrow money." So there's nothing wrong with a scenario if you're in a season of life that forces that upon you, right? If that makes sense, or if that's kind of where you are. So no, there's no judgment that comes with it. But in terms of who this works for, when it works, there has to be surplus, and you have to be disciplined with your finances. You have to be able to manage your spend in a way that there's a surplus every month, and that surplus is what pays down the house. Now, if there's $1,000 surplus, that means the home gets paid down by $1,000 a month. Well, if someone owes $100,000 on a house, $100,000 divided by $1,000 a month, that's a $100 payoff, which is about an 8.3 year payoff.
Yep.
I may or may not have prepared that. But if you owe $1 million, right, and you're paying down the house, and there's a surplus of $1,000 a month, it'll take you 1,000 months to pay off.
Yep.
Right? And so that's a key understanding, where the surplus every month has a direct relationship with the balance and how long it takes to pay off. So first thing is to ask yourself, are we disciplined with the finance with our money? Do we make more money than we spend? Is there a surplus every month? And is it pretty good? Are we good with our money, right? If the answer is yes, then what you do know is that you might be a good fit for this at that point, because the individual budget compared to the balance drives the outcome. So each person's individual household budget as compared to their household drives to the payoff time. Well, some people might be happy with a 12-year payoff.
Yeah.
And some people might not. They may want a 4-year payoff. And if at 12, they may pass on it, and that's okay. So it's really about once people have decided I might be a good fit for this, then there's a calculator that we've got. FirstLienHELOC.com is a website that you can go to that has a calculator that you input your expenses and your income, and it also you put in your balance to project how long it'll be for you to pay it off. So it's a little bit more involved than just, does it work for you? Yes. It's more of a process of like, okay, do we have the qualities that people who succeed with this have? If so, then let's learn more about that and see, with our particular scenario, what would it look like? And is it something that we would want, or is it not? And so I like it because I let the numbers do the talking. I stink at sales. I like teaching people things. And so it's not about convincing someone to get it. It's really more of a discovery experience where we understand, with your particular scenario, is this good? And I'm not even the one to decide whether it's good or not. And so, yeah, it's in terms of who it works for, it's just really it's discipline, making more than you spend, having a surplus every month, and then learning about it to see, is this the financial vehicle that is better for you?
Yeah. I love that. I can tell you this. Just a few weeks ago, I was chatting with a young lady here, one of our clients, kind of walking through our save and spend system, and I referred her over to First Lien HELOC, to you guys, and she came back a few days later and let me know, and she said, it doesn't work for us, and I actually figured that out on the first phone call, and I love that about your referral. She was like, it was so great. They walked me through it. I know what was happening. I knew the numbers. We looked at the calculator. It doesn't work for us. That was awesome. And that was her feedback. She was actually very excited and happy. She was like, I love that. Who's next? Who else should I go talk to? And she was like, I love that so much. And so I can say, I can just reiterate some of the things that you're saying on this podcast episode here. This is not something that fits everybody. And so we want you to know that at home here, whether you're listening or watching, it's not for everybody, but if it works for you, it really can speed up the debt payoff, the house payoff process in your life. which is awesome. And again, depends on lots of factors like Anthony said, but we love that. Okay, so if you're listening or watching, in the description of the video, in the show notes of the episode, you will find the links that you need. Anthony's mentioned firstlienheloc.com. You'll find that in the show notes. And of course, we have a specific call to action, a specific calendar for you that you can click on. You can go directly to the source, book that call, have a little bit of a consultation, and figure out if a first lien HELOC makes sense for you and your family. So click the show notes of the episode, and that's how you'll get more information. Anthony, we really appreciate you being on today's episode. Is there any closing thoughts you've got for the folks that are listening and watching?
Guys, I appreciate you, everyone just listening and considering looking into this. Our job is to educate and advocate for what this is and the fact that it's a viable option, and it can improve people's lives when it makes sense. So I invite you to learn, go down the rabbit hole, look up first lien HELOCs, pros and cons, and understand what it is, because it is an option that's out there, and for the right person, it can be a game changer.
I love it. I love it. On your journey of the save and spend system, in stage 2, where we talk about savings, where your expenses are coming down, your income is going up, we think that for the right person, the first lien HELOC can make all the difference. So click on those links in the description of the episode, in the show notes, and book your call today. All right, today's top 5, it's a fun one. These are actually the 5 movies that actually teach powerful lessons about money and business. So coming in at number 5 is The Founder. Now this movie tells the story of Ray Kroc and the creation of McDonald's. But what's fascinating is the real lesson behind the business. Ray Kroc realized that the true wealth wasn't in selling burgers, it was owning the real estate under the franchises. And that insight completely changed the business model and turned McDonald's into this global empire. You should watch it. At number 4 is The Big Short. Now this movie breaks down the 2008 financial crisis and shows how a few investors saw the housing market collapse coming long before anyone else did. It is a great reminder that markets can be irrational and that sometimes the biggest opportunities come from questioning conventional wisdom. All right, coming in at number 3, Moneyball. Now, while it's technically about baseball, it's a baseball movie, the real lesson is about challenging traditional thinking. The Oakland A's used data and analytics to compete with teams that had far larger budgets. The lesson here applies directly to finance. Sometimes the smartest strategy is simply looking at the problem differently. At number 2 is Wall Street. Now this is a classic movie, and it highlights both the attraction and the danger of chasing money purely for profit. It shows how greed, speculation, short-term thinking can create enormous risk. If you haven't seen that one, like I said, it's a classic, you should watch it. And the number 1 movie on the list is actually It's a Wonderful Life. Believe it or not, this movie actually gives one of the best explanations of how banking works. It shows the importance of community banking and how money flows through a financial system. I know it's a Christmas movie, but even if it's not Christmas, you should give it a watch and you should look for that explanation of how banking actually works. And that's today's top 5. And if you like this episode, you're going to love our next one. We are talking to Michelle Prather. She has a company called Care Income Planning, and she's going to walk and talk us through long-term care insurance. If you have not heard of that, if you are not prepped for that, you need to be a part of this conversation. This is so important. The statistics say that the probability of you or your spouse, if you're married, having some sort of long-term care episode is extremely high. And if you don't prepare for it now, it's insurance. It's one of those things that you've got to buy before it's necessary. So Michelle will walk and talk us through long-term care. She'll even talk a little bit about how to stack that or ladder it, so that way you don't have to have such a big cost now. I know that she employs that personally. That's what I'm looking forward to doing as well in my own personal family. So long-term care is what's coming up next on the Banking Bros podcast. Of course, we're going to have a little bit of fun and games and trivia and all the other things that you have come to love. But the next episode is one that you absolutely have to be a part of. Stay tuned, keep listening, subscribe to our channel, follow for more, and we'll see you in the next episode.
Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.